I discovered the best strategy using fair value gaps that has changed the way I trade
forever.
In this video, I will show you how to correctly identify fair value gaps for the best entry and exit possible. But first, before I get started, let's talk about what fair value gaps are and why they are so important to understand. A fair value gap, also known as FVG, occurs when there is an imbalance between two price levels, forming a large gap in the candle. This means that there was too much buying power where orders were left unfilled. The only fair value gaps that you should pay attention to are the very large gaps. The small gaps like this can be ignored since it was filled almost completely already. Now that we know what a fair value gap is, how do we take advantage of it when we trade? Well, what we are looking for is for the price to come back to a fair value gap and fill it, giving us a high probability indicator for the market to reverse. Now I know what you're thinking. Take a trade on every fair value gap you see, right? Wrong. Not every fair value gap works the same. For example, when the market is trending, there are fair value gaps within the trend, like this. But this fair value gap can be considered as a small support level and not a reversal indicator, where price tends to bounce off of to continue the trend. But the longer the trend, the higher chance for it to invalidate these support levels. If you were to take trades on every fair value gap you see, I can guarantee you will lose money. The only fair value gap that you need to look out for are the ones that happen after a liquidity sweep. I will leave a link in the description to my previous video about liquidity sweeps that you can also check out. After you find a liquidity sweep, look for a fair value gap right after, just like this. Mark the fair value gap and wait for the price to come back to it. Remember, this gap has unfilled orders that need to be filled in order for the price to move. After seeing the market move into our fair value gap, we need to wait for a final confirmation in order to execute the trade. If the price decides to push past our fair value gap, we will immediately stop looking for an entry. But if the price decides to tap into the gap while not breaking through it, we can place our trade with confidence. If we let the market play out, we can see that the price tapped into our gap and closed above it. This is the exact location where you want to enter the trade. Place your stop loss below the liquidity sweep and your take profit at previous highs. Now, because of this liquidity sweep plus our fair value gap being confirmed, the odds of the price hitting our stop loss are really low. As you can see, price has reversed and is now in a bullish move upward, hitting our take profit along the way. If we take a closer look at this upward trend, we can see more fair value gaps being created. If you remember in the beginning of this video, I talked about how fair value gaps can be used as support in a trend. If we combine this knowledge into the trade that we took, we can hold onto our trade until one of the fair value gaps in the uptrend is broken. And no, if a candlestick's wick goes past a trending fair value gap like this, that doesn't mean that the fair value gap is invalidated. If anything, it shows us that more orders were being filled to push the price higher. This is a safe and secure way to protect our profits and capitalize on the majority of the trend. Let's take a look at a live trade that I took on the S&P using this strategy. The very first thing I looked for was a liquidity sweep to the downside, just like this. After that, I noticed that the trend was starting to retrace back to the upside. Instead of trying to guess my entry and hope for the trend to continue, I waited for confirmation to enter the trade using the fair value gap that was created here. You may have noticed that there's another fair value gap located just above the previous one I marked out. We can also mark this out as well for extra confirmation, but our main focus is on the first one. After I saw these two fair value gaps being created, I wanted to see price touch and reject these areas. A couple of minutes go by and we can see that the price did exactly what I needed to happen. I entered the trade right after the candlestick closed and put my stop loss below the liquidity sweep. Before the market opened, I already had previous highs marked out, so I moved my take profit at these highs after I entered the trade. Price was moving in my direction and started to trend upwards. I can't lie to you, I was celebrating this trade because it shows how powerful this strategy is if you fully understand how it works. Hopefully by now you understand the differences between fair value gaps and how to use them to your advantage. There are other confluences that you can combine with liquidity sweeps and fair value gaps that make the odds of winning the trade even higher. So if you'd like me to make more videos explaining that, let me know in the comments. I will try my best to give you the simplest explanation that is easy to understand and apply into your trading strategy. If you found some useful information in this video, remember to leave a like and subscribe so I can post more content just like this. Thanks for watching, and I'll see you in the next one.